Welcome, everyone. This is Adam Coleman. Today we have David Wanja, who is a certified financial planner with Financial Synergies Wealth Advisors in Houston, Texas. We're going to talk a little bit more about different retirement strategies, both pre and post-retirement. So, David, thanks for being here.
Adam, no, thanks for having me on today. I'm excited to visit with you about financial planning, and I look forward to providing some value. So thanks again for asking me to join you.
Yeah, it's a pleasure having you. Well, before we begin, tell me a little bit about kind of what made you decide to go into financial planning in the first place.
Yeah, so I'm a career changer, right? So I played tennis for 10 years, kind of coaching wise, and enjoyed that. And having a family and not wanting to be on the court for 50 hours a week drove me to being able to work towards becoming a financial advisor. I had a friend that was in the industry and they thought I'd be great at it. So got into the industry, worked my way through and got to Financial Synergies and started on the wealth management side. So that post-retirement side, helping people navigate retirement topics. And we had an opportunity pop up where I could run our young professional program. So got to see both sides where you're talking about pre and post-retirement planning.
Nice. Yeah. In that niche, a lot of people don't really focus on that young side. A lot of financial planners obviously gravitate towards either the retirees or very soon to be retirees. So I'm looking forward to hearing what you have to say, especially on that younger wealth accumulation side. So jumping more into that, obviously retirement planning has a lot to do with like the tax strategies involved. And there's kind of that 3 buckets of money concept. So maybe talk a little bit about what classifies as taxable, tax deferred, and tax-free money from the retirement standpoint.
Yeah, so if you think about it, and I'll kind of probably jump back a little bit. If you think kind of the idea behind the 3 bucket approach is you're really looking at financial flexibility in the future, right? The idea is to be able to navigate different topics that are probably going to come up in retirement. They could come up before that, but I think it's, again, trying to set yourself up to navigate topics like taxes, gifting, maybe even estate planning at the end in retirement. So the idea is maybe have a bucket of money that's going to be tax-free, thinking a Roth IRA or Roth 401k. You'll have tax deferred being your IRA or a 401k, and then the taxable bucket being a brokerage account. And I think in that is, let's pick on taxes a little bit. So you're trying to navigate that topic of what our taxes going to be in the future, which we don't know, right? I wish I could tell you this is going to be the tax bracket, but we don't. But the idea is we can go through this and go through the planning process. And if we have buckets of money, we can navigate kind of wherever the tax brackets fall and where this person falls in line with those tax brackets. And we'll be able to navigate that and pull different money when it makes sense. You know, a personal story when the light bulb went off about the bucket approach to it was my grandmother. I remember her coming to me one time and was like, I'm getting beat up with taxes. What should I do? And we talked about her situation, and you're looking at somebody that had Social Security, a pension income, and then had her IRA, which she had to take her yearly RMD from. And she's like, I just want to take more money out and convert it to Roth. And just after running and talking about the taxes, it just didn't make sense to do it. But then that's when it was like, well, here's kind of what should happen if we kind of do it on the front end of that accumulation stage, and you slowly build these buckets. It's hopefully going to make planning a little easier on the back end of it and be able to navigate those kind of topics we talked about. And then at the same time, I think the 2 buckets that get talked about the most are probably your tax deferred and the tax-free accounts. So you're really looking at 401ks, IRAs, and Roth IRAs. I think, again, they get the traditional retirement account label. So they're really the ones that you can find a lot of information on the internet or even from advisors. It's just talked about. And then I think the one that's missing, and I think that this is where it's starting to get a little bit more light shed on it, is the taxable account, where you've got a lot of flexibility to it. I mean, a couple of nice things that are not mentioned about it, but should be, or there's no income restrictions on it. There's no early withdrawal penalties. There's no contribution limits. And then at a really high level, there's actually, like, depending on who you leave this account to, the person could actually get a step up in basis when you passed away, leaving it to somebody. So there goes back to that estate planning topic. So again, I think the idea behind all of this is we don't know what's going to happen in the future, but this is going to give us some flexibility to navigate some of these topics by having some money in each of these buckets.
So in terms of the sequence of how people should invest, especially early on in their careers and wealth accumulation stage, what do you see as the order of operations of what you invest in first?
Yeah, I think first and foremost, it's having that bucket of cash. If we're going to stick with the bucket ideas, like we want to have cash. If something happens, you're able to pay for something. So having that emergency fund or the cash reserve. is really, really important. And then from there, you go, hey, we want to invest up to your company's match. It's about as free of money as there possibly is. So it's kind of nice one to get that employer match there. From there, I think it's great to go. And if you have the ability to invest or max out a HSA account, so a health savings account. So that way, then you're taking some of your taxable money off the table, but being able to invest that in that health savings account for future medical expenses. Then from there, depending on your income limit, is either the Roth IRA or the backdoor Roth. And then this is probably a whole nother topic matter because if equity comp, but if your company allows you to do it, I think being able to max out an employee stock purchase plan is a nice one. Again, you're looking at buying your company stock at a discounted price of anywhere from 5, 10 to 15%. I'll caveat that and say that depending on if you're going to do it or if you're already in there, talk with a tax professional just when you try to sell so you kind of understand the taxes you may incur when you sell that. And I think these last two are interchangeable. Again, I really think it depends on the person and their situation and their kind of goals looking forward. But you can either go, hey, I want to max out my 401k, or the next side of that. And then after if you max out your 401k, you still have money left over, you could go to the taxable brokerage account and vice versa. I think, again, you could go taxable brokerage account if you need that flexibility more than the possibility of maxing out your 401k.
Where do you fit in like debt pay downs? So obviously differentiating higher interest rate debt and lower interest rate debt. Where does that fit into the equation?
I would put it probably right after the 401k match. I think getting that match is great. And then I think you talk about kind of free money. I think from there, then you've got to weigh the options of, does it make sense for me to kind of start maxing out an HSA if I have, or that health savings account, or unfortunately, depending on like kind of what that debt looks like, does it make sense to go in and work on paying that off, especially in the interest rate environment we are today?
And we're speaking to more consumer debt in terms of credit cards and personal loans, things like that. Because I get this question a lot of, should I pay down my mortgage faster or should I use that money to invest? So what do you typically advise on that side of things?
I think it goes back to that interest rate, right? You talked about credit cards. If you're at 20%, again, can't predict what the market's going to get in the future, but I think that number is really, really high. I think it probably makes more sense to go tackle the consumer debt. If we look 2 years ago, I think we're all looking at, you're at sub 2% or close to 2, which is kind of crazy where you're thinking there, where, okay, it probably just makes sense to pay the minimum and then look at going, okay, hey, the next dollar you have probably needs to go be invested, right? You're hoping over the long time you're going to come ahead. Now the flip side is you're at 6, almost 7% for a mortgage rate. So now maybe it kind of starts to make sense. Do I pay more on that versus investing? And I think you just have to have the conversation with people and educate them and go, here's the give and take on this, and making sure that everybody understands kind of where they're at on it, and just going, we can't predict what the market's going to do. It's out of our control, but we can focus on what we can control. Is that paying down debt, if that makes more sense? I always ask the question, like, how much is this going to keep you up at night? If it's going to keep you up a lot, then I think it kind of makes sense. And the number I always like to use, I think, is if it's below 4, I think you can invest. If it starts to get above 5, I think that's where you're starting to really focus on, should we put extra money towards the debt?
Now, would you ever put it ahead of maxing out the 401k to get the tax benefits? Or is it more just before we deal with taxable brokerage accounts, is that where it's fitting into the equation for you?
I think it really depends on the person and going, okay, are they really just debt adverse? And they're just like, hey, I don't want to have any debt and I want to pay this off. Even if we talk through the conversation and here's the outcome that could happen if you were to invest this money versus paying it off. I think sometimes it goes back to that person's just like, I can't sleep at night. My goal is not to add more stress. It's to go, okay, hey, you know what? Let's pay this off. I actually had a client kind of walk through this, and we talked about like we could refinance their mortgage when there was a chance to get a lower rate. And they were like, I understand the math and the logic behind it. I just want it gone. Like, I just want to know that, like, hey, I can stop paying this and then I'll start investing every dollar after that. So it's kind of an interesting one.
Situation where people just psychologically, it's so overwhelming to them that the math just kind of gets thrown out the window and it's just more mental at that point.
Yeah, you can throw the numbers out there and you can think about making sense number wise, but I think it just comes back down to being personal, right? And fitting into somebody's situation and being like, what is my pain point? And this is what I want to solve. And then I think from there, I mean, it just worked perfectly with this client, got rid of their mortgage, and it was like this weight was lifted off their shoulders.
Well, you obviously mentioned you focus on that younger investment crowd, the accumulation stage. So, what sort of advice are you giving for allocation or types of funds that they're considering at that early stage of accumulation?
Yeah, I think generally I look at it as like building a house. The goal is, especially early on, is let's get this foundation laid. And I think again, it's not so much of like we're trying to risk it and trying to hit home runs every time. We're just trying to hit singles and doubles playing baseball and just build the foundation and get it set up to where now all of a sudden we can frame the house and put the house together and going, the foundation's already been laid. We're just using simple, especially for our firm, we're using simple index funds, just keeping it really basic and going, we're in this for the long run. It's going to take some time for this to work. But instead of like trying to pick one hot stock and getting it wrong, and then all of a sudden it's a whole different conversation. And nobody wants to have that one.
Right. Well, no, absolutely. So mostly index funds, kind of keeping it fairly basic, but then a fairly heavy allocation towards the equity side of things early on, I'm assuming.
Yeah, it really depends. It's something we talk about like all the time, but you think about like risk management. There's some people that are going, I can handle 100% equities and I can understand the swings of up and down. And then there's some people that come in and go, I can't, right? And I think it's a very interesting one when you look at it from the retiree side and early on, like the accumulation stage, where I think if somebody hasn't invested, especially even outside your 401k, because I think at times we look at our 401k, but we also know that's like, again, a retirement account. So I'm not going to touch this money for years. But once you start adding that brokerage account, I feel like it's something different, especially if the money's been in cash and it's been, hey, this steady line of just going, it's about the same the whole time. Now all of a sudden you're watching this money move up and down. It's a different mindset. So I think having people have that conversation of understanding like, hey, we're still using this brokerage account, looking at it as a retirement account. If something happens and we deplete the emergency fund, then you could go kind of that count next to get money out. But again, I think the idea is we're going to have this bucket of cash for emergency fund. And then from there, we're still thinking about, okay, hey, we're looking at this long term. So let's add extra money that we have into the brokerage account to help you get to your retirement goal sooner.
What's sort of your rule of thumb for the emergency accounts early on, not retirees, but early accumulation stage?
So the book behind me somewhere over here would say that it's like, I think 3 to 6 months. And now this gets really into like, really, I go back to the personal side of it where there are some people that can go, hey, you know what, I can have a month and a half and be okay. Now, again, I think, is that more for somebody that's single? Possibly. You start adding a family in there, you probably want a little bit more cushion. I think the 3 months is good. 6 months is really nice. Then you add, especially, so I'm in Houston, so you think about oil and gas, very cyclical. You may want even more money than that in cash because you just don't know what's going to happen. When oil and gas is great, it's great. When oil and gas is tight, it's really difficult. So, and we see layoffs a lot in Houston. So it's one of those ones where it may make sense depending on your job just to have a little bit more cash there. And I think it's just talking back with the person and making sure they understand both sides of the coin of going, hey, are you sitting on too much cash or are you also not having enough cash as well?
Now, one thing I see a lot of people do is when they think of cash, they end up just leaving it in a checking or savings account. Now that rates are ticking up a little bit on certain accounts, are there certain ones that you tend to gravitate towards with your clients?
Yeah, so it's a very interesting one where we're trying to do this with our clients is thinking about there's some money market funds you can put money into. So that's kind of a great one. Depending on when you need the cash, a CD is not a bad option. Just know that the money's going to be locked up. There are some penalty-free CDs where you can get money out of, but just be careful on that one. And then, high yield savings accounts, right there. I think there's a lot more out there and options. There's online ones. It's just trying to make sure you find the right solution that fits your needs. I think for us, we like the money market funds to be able to put it in there. I think we're using a couple at Schwab and Fidelity that are earning kind of close to 4.7%. So there's definitely a nice yield on cash that hasn't been there in a long time.
Do you find that the people kind of gravitate towards high yield savings accounts versus money market funds mostly because of the FDIC insurance, or is it just some other reason why they like one over the other?
I think it's just the education piece on it. Yes, there's the FDIC insurance on the savings accounts and checking accounts there. But I think at the same time, do you talk through, hey, we keep the emergency fund money at a bank and then maybe every dollar over that, if you're kind of thinking about an expense that's coming up, do you put it in a money market fund?
Gotcha. Does that shift any way in terms of advice when they're getting maybe 5 to 10 years before retirement as they're shifting closer and closer to that date?
I don't think the advice changes because you're still thinking about the client's goals. I think there's different topics that probably come up. We're thinking about partly, are they going to be investing catch-up contributions depending on where they work and what the incomes look like? Do we have extra money to kind of make those contributions there? I think it goes back to, like we talked about, it's that risk management piece that we've talked about the whole time, especially kind of early on, and then have focused on it now. But at this point, you're really playing for keeps, right? So this money is going to be used soon, 5 to 10 years, it's going to blink and we'll be retiring. So I think this one is thinking about, okay, if we're thinking getting close to here, how can we start taking risk off the table? Does it make sense to dial down our unnecessary exposure that maybe you had when you were 20 or 30 and we're like, hey, I can go all equities, I can swing with the market, I can do it. Where now the sequence of return risk is real. We can't control what the market's going to do, but as advisors, what we can do is take some of that risk off of the table a little bit. Again, I don't think anybody wants to have the conversation as an advisor to a client of being, hey, you know what? We didn't do this, and now all of a sudden you got to work another 5 years. Where if we can't control what the market's going to do, but we can go back and go, this account is going to be the one that you're going to take money from early on. So let's just take some of that risk off the table.
Is it changing the emergency fund much at all at that stage, or is that more something that changes really a little bit closer to retirement?
It depends. I think there's a kind of a balance of both. I think depending on the person's situation, right? Is there any income that's going to be coming in? Did they defer any income that may start kind of coming in when they retire? If not, then maybe we build up that cash a little bit more. And then at the same time, as we're getting closer to retirement, maybe in the portfolio, we're doing something to where there's a little bit more cash there. So we don't have to worry about trying to sell something if we don't need to.
Gotcha. What's your thoughts on like target date funds, things like that, that are kind of set it and forget it type of investment options?
Yeah. So no, I think for early on investors, I think it really kind of depends on your kind of personality. I think if we go back to 401ks and going, I've seen this as an advisor where you've seen 401ks in cash, you've seen it all in bonds, and you've seen people use really high expense ratios on the funds that they chose inside their 401k. And what I've done is just like listen to clients, understanding kind of why they chose what they chose. And you kind of get down to the nitty gritty of it. And it goes back to just almost over analysis or just kind of pushing it to the side. And I think it becomes one of two things. Like one, I didn't have enough options. So I was almost scared to do something like, which fund do I put this in? Because I don't know. Or the other side is I had too many funds and I didn't know where to begin.
So we've talked about up through retirement, or at least 5 to 10 years before. What about the advice or asset allocations or anything? How does it change at retirement when it comes to the advice that you're giving?
Yeah, it's an interesting one because the conversation changes naturally and at the same time also stays the same. So if you think that like what changes, right? You've had this person that's worked all the time, they've accumulated wealth. Think about it. Hey, every either 2 weeks or once a month, they had a paycheck coming in. So there was always this money coming in and knowing that. And then all of a sudden, hey, that light switch is now turned off. So now the client is now living off of everything they've accumulated. And it's stressful, right? It's not easy. We're all human, we're all emotional, and it's very difficult to go, hey, I've been making money and now, okay, I've got to take from this kind of accumulation that I've had, all this wealth that I've made. And our goal as an advisor, and I think what's important is the sooner you talk to an advisor, the more you can plan for retirement and then hopefully reach your goals in retirement. But then at the same time, you're still thinking you got to be a long-term investor. So it's our goal, again, taking the risk off the table, helping them realize they're going to be okay as much as we can. I mean, there's certain things that are out of our control, but again, we're taking this and going, here's kind of the situation that we have. Here's what we're planning for. Here's how we're looking at this. And then at the same time, remembering that if you had somebody that started working at 25, retired at 65, you can still live to 95. So you've got another 30 years to kind of live off of this. So also thinking long-term as well. So it's just having those conversations where we're still a long-term investor, but there is kind of that short-term mindset where you're like, I need this, but we're also kind of planning for that at the same time.
Yeah, I mean, I think that was always my problem, is everybody's so focused on getting safe, conservative investments. Like that's always what you hear. And you can live for another 30 years after that. There's a pretty big window of time where you're still going to need some returns. You can't just go with the safest option in a lot of cases. So just trying to allocate things, still thinking long term, It's hard to wrap your head around the differences between those when you're really at retirement as well. But I'm assuming that kind of speaks to not necessarily emergency funds, but cash funds as you get to that stage, to not have to deal with the sequence of pulling money out of retirement accounts and things like that. Correct?
Yeah, no, you're right. I think the portfolio kind of changes a little bit, where maybe you're having a little bit bucket of cash that instead of, it's probably maybe a year, 18 months worth of cash kind of inside of it. And then kind of the allocation slowly shifting, but you're staying there being like, we can just kind of take this and, we can send money to a client when they need it, but it's already there in cash. You're not having to go to the portfolio depending on what the market's doing, because we can't control that. But if we know we got this bucket here, we know what living expenses are, awesome. We can kind of go back to this, and we run that all through the plan. So we think about, okay, hey, what are your living expenses going to be? Hey, can we live off of what we've got? At the same time, then, like you said, if we've got these different buckets there, then we can kind of go back and, hey, maybe we're leaving something else to be a little bit more aggressive, but we're focusing on this one account of being able to pull money from.
Perfect. Well, no, this has been super helpful. Any other final thoughts or any other advice that you'd be giving to the people that you typically deal with?
I think my advice always is get a plan in place sooner rather than later. The major thing that can derail your retirement plan is not planning for it at all. I think you owe it to kind of yourself and your family to kind of think about the future, and there's no better time than today to start planning.
Absolutely. Well, if anybody wanted to get more information on you or your firm, what's the best way to find you?
So www.finson.com, and kind of look through our website. We've got links to be able to kind of schedule calls with us. So feel free to reach out if anybody has any questions.
Perfect. Well, I'll make sure to put the link in the description as well. So definitely reach out to David if you have any questions whatsoever. This has been great. I really appreciate you taking the time, David.
Yeah, Adam, I enjoyed it.
Thank you. Have a good one.
You as well. Thanks.